Most people who stay broke are not staying broke because they are lazy. That's the comfortable myth. The story people like to repeat is simple. Work harder, grind more, want it badly enough. But if that were true, the people working the longest hours would be the richest. And they aren't. Warehouse workers, delivery drivers, nurses, construction crews, 40 hours, 50 hours, sometimes 60, still stuck in the same financial place year after year. So the real question isn't motivation. The real question is structure. Because when you look closely, something strange appears in the data. The people who quietly move out of being broke almost never do it through one big moment. No miracle investment, no viral business, no sudden promotion. Instead, they do something much less exciting. Something small, something repetitive, something daily. And if you actually follow the numbers, the uncomfortable conclusion is this. Staying broke is extremely easy, but it becomes surprisingly difficult if you do one specific thing every single day. Not once a month, not when you feel like it, not when your bank account finally looks comfortable. Every day. And in 2026, that small daily action matters more than it ever has, because the economy has quietly changed the rules. Think about the typical financial life cycle. You get paid, you pay bills, you buy groceries, maybe you save a little, maybe you don't. Then the next paycheck arrives and the cycle repeats. Income flows in, money flows out. But here's the detail most people miss. Income happens in bursts. Expenses happen continuously, and wealth grows only when money stops moving. That's a quiet mechanical rule of personal finance. Money that keeps moving through your hands never compounds. It disappears into rent, food, subscriptions, convenience purchases, and tiny transactions that feel harmless in isolation. But together they form something like gravity. Constant, predictable, pulling everything back down. Now here's where the daily action enters the story. Because the people who escape this cycle do something that interrupts gravity. Every day, they force money to stop moving. Not large amounts, often absurdly small. $5, $10, sometimes less. But the action happens daily, and that changes everything. Let's look at a simple example. Imagine two people making the exact same salary, $40,000 a year. Person A saves nothing during the week. At the end of the month, they try to save what's left, which is usually nothing. Person B does something slightly annoying. Every single day, they move $10 out of their spending account. Automatically. No decision required. $10. That's it. Most people would dismiss that as meaningless. But watch what happens to the math. $10 a day becomes $300 a month. $3,600 a year. Invested in a basic market index returning around 7% annually that grows to roughly $50,000 in 10 years. Not life-changing yet, but something has quietly shifted, because after 10 years, the person saving $10 daily is no longer starting from zero. They have capital, and capital changes the game. But the real mechanism isn't the $10. The real mechanism is behavioral friction. Most financial advice assumes people are rational planners. They aren't. Human behavior follows momentum. If money is sitting in your spending account, it will eventually be spent. Not because you're irresponsible, because the environment encourages spending. Ads, notifications, limited time offers, one-click payments. Entire industries exist to remove friction from spending money, which means escaping that cycle requires adding friction back. And the daily transfer does exactly that. It quietly moves money somewhere harder to reach. Not impossible to access, just inconvenient enough. In behavioral economics, this is called a commitment device. You make a decision once, and the system carries it forward. That's the real trick. Not discipline. Structure. Now here's where 2026 changes the picture. Because the cost of living has risen faster than wages in most developed economies over the last 2 decades. Housing, healthcare, education, even groceries, which means the margin most people live on has shrunk. And when margin disappears, the idea of saving large amounts becomes unrealistic. But small daily actions still fit inside narrow margins. $5 still fits. $7 still fits. The daily habit survives where big monthly plans fail. That's the first quiet advantage. The second advantage is psychological. Monthly saving feels painful. Daily saving feels almost invisible. $10 disappears quietly. You barely notice. But the accumulation doesn't feel invisible forever, because eventually the balance starts looking different. $500, $1,000, $3,000, and something subtle happens. For the first time, you have options. Options most broke people never experience. Let's talk about what those options actually look like. The first is resilience. Most financial emergencies cost somewhere between $500 and $2,000.
Car repairs, medical bills, unexpected travel. If you don't have cash, those emergencies turn into debt. Credit cards, high-interest loans, payment plans. And debt has its own gravity. Once you enter that orbit, interest quietly drains future income. But the daily saving habit slowly builds a shield against those moments. Not instantly, but predictably. The second option is mobility. Most people stay in bad jobs longer than they should. Not because they enjoy them, because leaving feels financially dangerous. When your bank balance is close to zero, every decision becomes defensive. You stay where income is predictable, even if the long-term growth is terrible. But having even a few months of expenses saved changes the risk calculation. Suddenly switching jobs becomes possible. Taking a chance becomes possible. Negotiating becomes possible. Again, not dramatic, but structurally different. Now here's the part people don't like hearing. The daily saving habit by itself will not make you rich. That's not what it does. What it does is remove the most dangerous financial starting position. Zero. Starting from zero means every opportunity is out of reach. Every risk is terrifying. Every mistake is expensive. The daily habit solves that first. Quietly, slowly, predictably. And once zero disappears, the entire system behaves differently. At this point you might be thinking, fine, $10 a day. But that still takes years. Yes, that's the uncomfortable truth. Real financial stability is slow, which is exactly why so many people chase shortcuts instead. Crypto windfalls, day trading, lottery-style investments. They promise speed, and occasionally they deliver it. But statistically, most people lose money chasing volatility, because fast money is usually unstable money. The daily habit does the opposite. It creates slow, boring momentum. And boring momentum is incredibly difficult to reverse. Now let's zoom out for a moment. Because something interesting is happening globally. Technology has made earning opportunities more flexible than ever. Freelance platforms, digital marketplaces, remote work. But the flip side is instability. Income can fluctuate. Contracts end. Algorithms change. Platforms evolve. In unstable environments, financial buffers become even more important. And buffers grow from accumulation, not sudden wins. Which brings us back to the daily action. Because once someone has built the habit of moving money daily, a second opportunity appears. Daily income experiments. Selling digital assets. Freelance microtasks. Online services. Even earning $5 a day creates a strange mirror effect. $5 earned. $5 saved. Now the system begins feeding itself. Income produces capital. Capital produces flexibility. Flexibility produces opportunity. And the loop repeats. Here's the hidden mechanism underneath all of this. Compounding behavior. Not just compounding money. Compounding decisions. The person who saves daily becomes someone who thinks about money daily. Not obsessively. Just regularly. And that awareness quietly changes other behaviors. They compare prices more often. They question subscriptions. They think about opportunity costs. Small decisions improve. And small decisions compound. Meanwhile, the opposite pattern also compounds. Ignoring money today. Ignoring it tomorrow. Ignoring it next month. Eventually the numbers become intimidating. Balances feel overwhelming. And avoidance becomes the default. That's another form of gravity. So when someone says it's impossible to stay broke if you do this every day, they're not talking about a magic trick. They're talking about probability. If money leaves your spending account daily and enters assets daily, eventually something accumulates. And once something exists, it begins interacting with the financial system differently. Interest, investment returns, opportunities. 0 becomes 1. 1 becomes 10. 10 becomes momentum. And that's really the point most people misunderstand. The first $1,000 is not important because of its size. It's important because of its direction. For someone who has always been broke, money normally flows one way. Out. Rent. Food. Bills. But the first 1,000 proves the direction can reverse. Even slightly. Money can flow inward too. Once that direction changes, staying broke becomes much harder than it was before. But there's one final piece to this story. Because the daily habit only works if it happens automatically. Relying on motivation will fail. Every time. People get busy. They forget. Life interrupts. Automation solves that. A scheduled transfer. A rule inside a budgeting app. An automatic investment. The decision happens once. Then the system runs quietly in the background. Almost boring. Which is exactly what you want. Because the most powerful financial systems rarely feel exciting. They feel routine. And this is where the story becomes slightly uncomfortable. Because none of this is new. The idea of consistent saving has existed for generations. What's different now is the environment. In a world designed to make spending effortless, the smallest act of friction becomes powerful. A $10 transfer. Every day. A tiny interruption in the flow of money leaving your life. Do it long enough and something unusual happens. The balance grows. Options appear. Risk becomes manageable. Opportunities stop looking impossible. And eventually, almost without noticing, the person who once lived paycheck to paycheck is standing on the other side of something they used to think required luck. Capital. Not millions. Not overnight wealth. Just enough to change the direction of the system. And that raises a strange question. If escaping being broke can begin with something as small as a $10 daily transfer, why do so few people actually do it long enough to see what happens next?